All right, the webinar is now live. We are broadcasting to all the attendees. Everybody, thanks for joining us here today for this webinar put together by Freight Friend and Kinetic, talking about strategic capacity planning in a volatile market. This is going to be a really incredible conversation. We have just three absolute legends. Like, I can't say enough great things about these folks and how highly I think of them. So I'm excited to hear this. If any of our prep, I mean, even just sitting in the green room before we came into here is any indication, it's going to be really interesting and stimulating stuff to hear us all talk about. So I'm definitely excited. I'll go ahead and let the panelists introduce themselves. We'll start. Pickett, let's start with you.
Sure. Good afternoon, everyone. I'm Chris Pickett, formerly of Coyote Logistics. Spent 14 years at Coyote, scaling it to the powerhouse that it has become, although certainly now remains a powerhouse as a UPS company. Prior to Coyote, most of my early career was in management consulting and software development, almost exclusively around supply chain management. While at Coyote, spent an awful lot of time trying to understand market cycles and pricing theory, predominantly because as a lot of larger brokers that take on larger contract positions, you're often sourcing the capacity to fulfill that contract promise based on a future spot market that has yet to evolve, right? So the better that you understand the path of your cost basis over the time at which you're making those contract promises, ultimately the better outcomes you can achieve from both a service level as well as a profitability standpoint. But ultimately, it was a way to help us from getting smashed by not understanding where the spot market was headed, and therefore putting our contract positions under severe and painful duress. Exited from Coyote really just recently at the end of 2020, have stood up an independent U.S. truckload market intelligence firm, Pickett Research, that's allowed me to continue some of that pricing cycle, research and development, and now I'm publishing most of that under Pickett Research.
Really creative name for your new business. Where'd you come up with it?
All the good names are taken.
I mean, it seems like, by the way, it seems like the research you did has worked out pretty well for Coyote. So, and obviously in every conversation I've ever had with you, it's amazed me how brilliant you are on this stuff. So definitely looking forward to having your insight. Noam, why don't you go ahead and introduce yourself?
Yeah, hi everybody. My name is Noam Frankel. I'm the founder and CEO of Freight Friend. Freight Friend is technology focused on the procurement side of transportation, primarily in truckload, through a CRM, a carrier relationship management platform, a friendship-based marketplace, utilizing machine learning, AI, and algorithms to identify the right carriers for the right loads. Our motto is really build relationships first and then automate, which is really what I've been teaching in the industry about relationships for over 40 years, and a number of you have probably heard me talk about that. Prior to that, I sold in a brokerage business called Optimal Freight, actually, to TFI. I built the truckload side at Echo Global Logistics when it was primarily just an LTL provider. And I started my career in logistics by founding and building American Backhaulers from its infancy, and ran it for the first 10 years with Paul Loeb, where a lot of terrific people, some of them on this call, really found their roots. Thrilled to be on this panel.
Definitely an OG, and Noam, thanks for helping get this set up with everybody and bringing this group together. This is going to be could not have gotten this group together without you. Glotz, we'll go to you.
Yeah, so
you look a lot younger in this picture, by the way. We need to talk a little bit about that.
That's actually what startups do to you. So
yeah, is this your picture on Tinder, right?
Yeah. So 25 years in the industry. Actually started my roots with American Backhaulers, which was acquired by Sage Robinson. I was one of the early employees at Uber Freight, and then spent some time in visibility at Forkites, and then last but not least, helping lead Shipwell as a former CRO there. So I've always had a focus, like many on this call, on removing friction in the day-to-day operation, thinking about how can we efficiently source capacity, how does that correlate with price, how do markets clear in an effective way. And so I'm thrilled to be part of this group and be on this panel today. There's a lot of insights that we'll share with you, a lot of different unique perspectives, and Thanks for having me.
Yeah, thanks for joining us, Glotz, man. Like I said, I mean, just three incredible folks. I'm Ryan. I'm gonna do my best to shut the fuck up because, like, what can I really add to y'all? I'm just lucky to be here. I was asked to be on here as an advisor for Kinetic, who's putting this together along with Freight Friend. My day-to-day job, I'm the director of engagement for Carrier Direct. We're a management consulting and technology delivery company focused exclusively on freight, transportation, trucking, freight tech. I have a podcast inside the Founders Studio, and my background, similar to Glotz's, and actually similar to everybody on this call, is really at that intersection of transportation and technology. So I'm excited to learn more from y'all on this call for sure. So we have a little bit of structure that is going to kind of guide the conversation, but my goal here is to certainly have you guys talk, share your expertise, and kind of review some of the stuff. So, I'm going to start, Chris, Pickett, with you.
Sure.
In this kind of market as it's changing, at a macro level, like, is this different than what we've seen before? And if so, how? And if not, kind of what do you expect to happen?
On a macro level, I guess I can answer this both ways. Are things different? Sure. Right. Have we had a global pandemic recently? No. Certainly that's different, right? We have a severe and sharp economic recession as a result, compounded with an unprecedented health crisis. No, these things haven't happened before, at least not in the same way. So through all these cycles, the things are always changing. But I'll also say that from a kind of a long-term year-over-year rate of change perspective, and the idea that spot rates tend to follow this recurring 3 to 4 year cycle of overshoot and collapse. We can talk about what I think drives that if we have time. From that perspective, you look at it on a chart, it doesn't look that different. And you may argue that the cycles maybe have gotten a little shorter in duration, a little faster. The amplitudes are maybe a little bit higher. We've got higher peaks or lower lows, but the kind of the episodic kind of oscillations of overshoot and collapse, rates look good. Let's bring in more capacity. Too much capacity comes in, you tank the market. Eventually enough surplus capacity burns off. If you look at that cycle in the context of what's happened over the last 12 months, things don't look remarkably different to me.
Glotz, when we were prepping, you kind of drilled into some of the micro and why, some of the trends that you're tracking there. You want to maybe touch on that and kind of how you see that changing at the micro level and how it might be different?
Yeah, I think, the evolution was already taking place as we were entering the pandemic. I think e-commerce was starting to take off. I think that certainly accelerated. We are in the age of the customer. I know looking back in my 25 years, we went from make to stock to make to order, make to customization, now hit a button and get my thing. And so we're really living in the age of the customer. I think what the pandemic did was simply accelerate that. I think that there's more sophisticated supply chains, more nodes at the down in the local DC level, urban distribution, et cetera. And I think changes in customer buying behavior. I know I made, more frequent, like less larger purchases. Now I make less frequent orders, and I do that exclusively online. They tend to be much larger. And so I think it has a bullwhip effect. I don't think the S&OP process and the forecasting is quite caught up with the evolution in supply chain. I agree with Chris overall that, from a cyclical standpoint, the cycle is pretty much spot on. But I do think there's pockets of that volatility predominantly caused by the lack of forecasting capabilities.
Noam, anything you would add to the two of these guys? Freight Friend is a data focused platform. What are you guys seeing in the public data that might suggest anything?
Well, I think there's two parts of the cycle and volatility. One is the frequency of the cycle, and the other is the volatility, how much the markets actually move from highs to lows. So I'd love to hear Chris actually comment on that a little bit too, relative to the timing of the cycles. But the other thing is in expectations in general, there is the actual data and there's what it feels like. And I think the reason Freight Friend originally raised this question with the articles that we wrote was because the pain that shippers and brokers have been feeling over trying to cover freight is feeling like it has been going on for a long time, and that the last time we felt severe pain was much more recently. And that, I think, gets into some of the stuff that Kris is talking about, is that smaller things are having impacts, that whether it is the freeze that we just had in Texas, which suddenly people thought things were thawing out and it was going to be an easier work week, they got hammered and they're still trying to uncover from that. So whether the feeling of uncertainty and insecurity that this market volatility creates is actually changing relative to the data is an interesting factor, and that also affects buying behavior. And I think people are looking for solutions to smooth out their ability to procure freight in this market.
That carries us nicely into this chart and some conversation where we can go a level deeper here. Quickly, before we jump back into kind of this conversation, I forgot to say on the front end, so hopefully this doesn't hurt, my royalties on this webinar. You guys can, anybody who's in attendance, you can submit questions through the Q&A button on your Zoom there, and we'll get to those with about 15 or so minutes left. So submit those. If there are ones kind of in cycle that make sense with the conversation, might throw some of those out. I saw Adam Eagle, you raised your hand, which I'm not sure what that means exactly. So feel free to submit a question. So, Noam, you touched on the question of whether or not this is speeding up, right? Are these cycles becoming more frequent? And what might be driving that? And Glotz, I know that when we were in prep, you said, hey, your perspective is they may be speeding up. And all right, Adam Eagle accidentally raised his hand. So Glotz, you said, hey, we think these might be speeding up. And can you give us some context on why you think that is, and what are you seeing that suggests that?
Well, I think overall at the macro level, it's definitely, it feels normal as it can be in a pandemic. So I agree with Kris's assessment there. Again, on the micro level, I think the volatility shifts very quickly. And so when you have an event like recently occurred in Texas, that's felt through the entire ecosystem. And the lasting effect on that is, it can be several weeks before we return to, what somewhat normal. But overall, I think the cycle is, it's been pretty steady during the course of my career. Yes. Are things happening more in real time at the micro level? Yes, that's speeding up. But overall, I would agree with Kris's assessment here. He has the data behind it to support that. But I think the pockets is where the volatility is really having an impact. And I think until S&OP processes get more in real time and get better there, you're going to continue to see these pockets that really light up. Also, I think the displacement too, we think about the pandemic and you displaced industries, networks had to reset. You had supplier disruption. So containers were stacked up on one side of the ocean. You had to look for alternative means. So all those things have very short-term implications on the market again. But I think, Kris's curve here is holding pretty much in line with what we've seen in prior years.
And I guess, to be clear, this data is based on, this is something that Coyote published when I was with Coyote Q2 of last year. So this is kind of in the midst of the kind of Q2 2020, COVID's here, everything has changed. You can't look at past cycles to predict the future. Wondering what was going to happen next. So this hasn't been updated, as you can tell, based on those dashed, forecast lines really since then. And again, but directionally, in terms of what has happened, it's pretty much panned out. The peak went somewhat higher. I think Coyote did a curve output webinar today based on that data that, I think it topped out closer to plus 45, 50%. And then the kind of the cast line really didn't breach positive until really just this quarter. So it was a little more shallow on the turn. But fundamentally, the path was intact. We got that tiny blip in Q2, which again, in the face of something like a COVID recession and healthcare crisis, you would think that, right, that spotlight would have broken down well below and created almost another trough, but fundamentally it didn't happen. And kind of in the complexion of the last, 15 years, right, that little blip is pretty consistent with what we saw with major hurricanes or kind of the last polar vortex in Q1 of 14, where, it's enough to kink the curve and kind of disrupt the cycle, but it's effectively a 1 quarter pause before, our regularly scheduled program, continues. And so if that's the case, there must be something more profound kind of behind the scenes here that's driving this recurring pendulum of every 3-ish years overshoot and collapse. And if you kind of look back from 7, the longer term history, it's hard to make a cohesive argument around things are getting shorter or even higher amplitude. If you go back just to kind of 15, you could say, okay, when we look at kind of ultimately how that peak is played out for 2020, 2021, the peaks have gotten higher and the troughs have gotten lower. Yeah, sure. But, again, looking at the 3 cycles before that, it's hard to make, at least for me, that kind of flat statement that, hey, things are fundamentally changing, right? You've got this kind of coiled spring action where, again, it's all compounding, right? So some of that makes sense. If you're comparing to a lower low, you're already set up to see a higher high, and vice versa, until something comes in and maybe recalibrates us back to some level. But from a duration standpoint, that first Great Recession cycle back in 08-09 was an 8-quarter cycle. The next 2 were 14 quarters. The 17 and 19 cycle was 12 quarters. And then the fifth one that we just entered in, Q1 of 2020, we'll see. But one of the lessons may be, when you compound the normal cycle with a recession like we saw in 08-09, maybe that, creates a compression and a much sharper drop and therefore a much quicker recovery. And we'll see if that plays out for the rest of this year.
Kris, did you do any correlation with the curve with respect to Class 8 truck orders as well? And if so, is there any insights to be gleaned?
Yeah, I mean, I'd say ultimately that's fundamentally what drives the cycle, right? You think, what would drive a cycle of spot behavior like this? It's got to be a oscillation of supply versus demand. When rate, the only thing that can drive spot rates higher is if demand exceeds supply. The only thing that can drive spot rates lower, it was the opposite. And I think if you overlay, year over year net Class 8 truck orders on this chart, the correlation is eerie, but yet completely expected. Where during the peaks, during the high, what's happened? Let's look at 17 to 19 when rates are higher. Again, so much of this is psychology, right? We all kind of settle into recency bias, like what's happening right now. It's hard to remember a time that didn't feel like right now, and it's hard to predict a future that doesn't feel like right now. So things always feel unprecedented and historical. And I don't know how many times I've heard, hey, in 35 years in this market, I've never seen a market like this. Well, if you've really been here 35 years, you have. You just need to work pay attention, or you don't remember. So what happens is, when you have surplus profit outcomes and a market as fragmented as the U.S. trucking industry, it becomes a great case for reinvesting in the fleet. Right, and whether you're reinvesting in just replenishment, right, you want to take advantage of better fuel economy, more advanced engines, better safety features, more automatic transmissions to make your power units more attractive to younger drivers, if that's relevant. Those are all very logical things to want to do when you have surplus profits to do that, rather than pay tax on those surplus profits. So whether you're actually adding net new trucks to your fleet or just replenishing, it doesn't really matter, right? Because there's so many of these carriers making these decisions in pockets where all your old trucks are replaced and go out to the secondary market, and that creates the avenue, right, for the long tail carriers, right, the small and kind of medium-sized fleet guys, which are the lion's share of the market, to enter in the market because they see that same high profit potential where rates are higher relative to cost inputs. And like any competitive market, right, eventually that brings in new supply over time. That supply relative to demand crashes the market. Rates tank lower, and eventually you go down to the trough like we saw in Q2 of 19, where eventually enough surplus capacity has no choice but to exit before the market hits a bottom, and then you make your turn, and then we head up the other side. And then by the time we get inflationary come Q1 2020, everyone's forgot about the last 3 years. And we're seeing that right now. If you look at Class 8 orders, Q3, Q4 2020, off the charts. You see how January is shaping up. I think the January number preliminary is putting Class 8 orders at plus 350%. And you're going to see another huge quarter in Q2 because you're coming off of comps where arguably those truck orders probably should have been made in Q1, Q2 of 2020 based on the shape of the rate curve. But in the face of an uncertain, COVID future, everyone basically, cut back on that CapEx. Of course, why would you, do anything otherwise? And so you kind of stalled out the order cycle, which I think will act like a bit of a coiled spring where you'll see a massive overshoot here on a year-over-year basis. And you'll see that last into probably Q2 of this year before, again, assuming the world continues to spin the way it has in this market, too much supply comes in, markets crash, and then, we're heading down the other side of the hill.
It's interesting. I'm sorry, go ahead, Glotz.
Well, I was just going to say, did you look at any other industries and any dependencies as an example from like the construction industry and how that correlates to adding new drivers as part of this curve as well?
It's tough to find. I mean, they're the whole, is there a driver shortage? Over the long term, sure. But over the short term, there certainly wasn't in 2019. Otherwise, why would rates have tanked that way? So, I mean, over the long term, yeah, I think if you map out over 25 years or whatever it is, yeah, based on how many drivers we think we'll need then versus how many we think will naturally come into the industry, that there's always a massive shortfall. But you go into these periods where, it's so episodic, where there's so much consistent volatility along that path, where there are obviously periods of time where you arguably have too many drivers. And again, it's hard to say that in a market like this, where it feels like the complete opposite. But I think we're going to see that, exact case by the end of this year. And so, yeah, typically, infrastructure spending, right? Construction is always kind of thrown out as the kind of competing, place to go for folks that would normally either jump in a long haul truck and drive longer distances versus go work construction and stay close to home. Or hey, if we get, a big infrastructure bill, this year out of Washington, which arguably very well might happen, does that create more pressure on the driver pool? And yeah, maybe it does, but eventually, wages will rise because they have to, and new driver capacity will come in somehow. Whatever that wage level is, the market will find it. So eventually, right, that gap is filled for the short term. Drivers come in, and then the market shifts.
I was going to say, transportation is really interesting, I think, right now because of the overlay of technology advancements and market dynamics against the fact that we remain an asset-heavy industry. And I think you could overlay equipment orders with driver hiring and raising pay and our responses to that. But as Glotz said, part of it is that markets are shifting faster, and that's true in all trading markets, right? The information is shared much more quickly everywhere. Something that happens in a local market is everybody knows about it instantaneously, and it affects everything else. So the market dynamics, and maybe even the fact that there's a proliferation of intermediaries, of freight brokers, is driving reaction to changes much, much faster. But we still are an asset-heavy industry that is still remains behavior for truck cycle orders, like Pickett is saying, drives this larger macro thing. And I think those two things playing against each other as the transportation industry is trying to pretend like it can become asset light, creates some interesting cycles.
Yeah, and I think not only asset heavy, it's always been a relationship business for the very simple reason that I have to transfer risk, right? And you think about building relationships, it's to create trust. Why do I need to do that? It's that risk that I have with this 80,000 pound bullet going down the highway and understanding all the customers I got to service, et cetera. I think technology, where sometimes it often gets missed, where somebody thinks there's going to be a silver bullet and automate all these things. I just don't see that happening. I think you need really good people. And I think technology can serve as that single source of truth and still help establish, trust there and enhance that relationship. But I think the technology is going to be more evolutionary, where you're helping people take these specific prescriptive actions, start reducing friction points in their day-to-day, provide them with the right amount of data to make informed and educated business decisions.
We call that was a part of all of this, where it's not just, okay, here's this and this, that. It depends. It's good or bad. It is. And it's a figment of the fundamental structure of the U.S. transportation industry.
Yeah.
And I think it's all about to what extent you understand the world around you, to what extent you see it, whatever it is coming, and what capabilities you build as an organization with technology, with a flexible operating model, with the relationships you have in place, whether you're on the supply side as a carrier or on the demand side as a shipper or broker, right? To be able to position your organization to thrive. Again, regardless of kind of where you are in the cycle versus just kind of hoping for the best. Like right now we're in elevated rates, and you want to find all the reasons why rates should stay elevated, whether they're economic or structural limits to how quickly more drivers can come in, whether it's the FMCSA, drug and alcohol clearinghouse, or the COVID-related bottlenecks at truck driving schools. You want to kind of put everything out there to try to convince yourself that rates should stay higher, but it probably is not going to happen. And so, barring that, if you believe spot rates are likely to kind of fade down, again, while contract rates are coming behind, I mean, this is a terrible story. Contract rates lag. So if you're predominantly contract biased, whether you're a large carrier, or a broker, or kind of where you sit in the market, you should see continued year-over-year rate increases through at least third quarter, right? Because all those contracts that got renegotiated at the end of last year, they're not resetting down. right? They're all resetting higher, and they're going to continue to reset higher, certainly through the rest of this quarter into, into Q2. And kind of by the time we get into, mid to late Q3, when you see eventually when that spot line diverges to the downside versus contract, you're going to be glad you have those contract positions.
So that's that touches on, Glotz, I got to hit on something that you said a second ago, Betty, because you talked about assistance with decisioning, and it's something that I'm super passionate about, right? Like presenting the C-level employees with the right data to make the decision and actually helping them make the right decision, instead of asking a human to consume all the information that they need, which is their current state, right? We have a proliferation of data. We just dump it on humans and we ask them to parse it all and make the right decision. Humans aren't good at that, right? And so presenting people with, and it's topics that we're talking a lot about these days at Carrier Direct with our clients, or that our clients, I guess, are talking about with us, is assistance with decisioning is kind of how we term that. I'm going to jump in with a question. Oh, go ahead.
I was just going to say, as an operator, I don't care about the 100 things that are going right. I care about the 3 problems that I have and how do I quickly and most expeditiously resolve those problems. And can technology enhance that decision-making? Can it emulate some of your best operators and give you that prescriptive path to that problem resolution?
And reduce volatility. I mean, this chart could also look like the day-to-day of anybody in this industry, whether you're a load planner, a driver manager, a carrier sales rep, right? Dealing with volatility because you have to deal with there are actions that are required today for good. Even when everything's going fine, I still have to click these buttons because I'm basically a switchboard operator, right?
And I don't care if you're a tech-enabled company or if you're what I think gets labeled as traditional, which I would argue there are no traditional brokers. Everybody's using people, processes, and technology.
You can't give away my secret sauce, bro.
But I think that everybody's looking to reduce OpEx, right? If I'm looking at a number one efficiency metric, it's how many loads per person per day can I handle as an organization? Where can I reduce the operational expense, get that higher EBITDA? This is an EBITDA-based business. Where can I get that? So I think, everybody's looking at whether you're, strictly a tech company or you're somebody that's been around for 20 years, people are looking to jump in and help solve that problem and do more with less. And I see the same thing occurring with, some of the technology, optimal dynamics as an example, where what if I could get 30 more minutes of drive time on my truck with freight on the vehicle? What does that do to my OpEx? What does that do to my efficiency, et cetera, for my fleet?
That, driver utilization is a question is something, and somebody just submitted it anonymously, which I'm hyped about. Driver utilization is a passion point of mine. Chris, you touched on driver shortage. I'm going to come back to that in a second. Greg Madianos, and if I just fucked up your name, feel free to at me on Twitter or something. I apologize. Thoughts on how these compressed cycles and wider swings, really, right? I mean, because that's the highs are high and the lows low, Pickett, as you said. How is that going to impact the RFP process from from y'all's perspective? We could start with whomever. Pickett, why don't we start with you?
Yeah, I mean, I think it aggravates it, right? So you think about, why does contract lag spots? Ultimately, contract rates are set based on observations of what's happening now and expectations as to, what the market's likely to unfold as over the term of whatever you're contracting for. So when you see that massive low in 2019, right? That's the psychology of the market, during the bid process. And so again, just like now, we can't foresee a world where rates are fundamentally lower. Back then it was hard to perceive a time when rates would be fundamentally higher. So everyone got to get a little bit more desperate during the bid cycle. Everyone's contracts get rebid down 10 or whatever percent. And then once we go into what happened in 2020, you get that massive divergence, and suddenly, holy cow, right? That's not what we signed up for. And you've got, the term, unforeseen, market, cycles, who could have expected what happened with COVID. We could have, expected this, therefore you have to go back and do mini bids and renege on contracts and everything else. So I think that it kind of aggravates and it sets up just how far the market's got to overswing to correct for that on the high, right? So I think there's kind of that compounding approach again, like that coiled spring, right? Where the more wrong everyone is on the downside when you priced it, right? The farther it's got to go on the upside, to correct for that. And I think that just kind of sets up kind of where that next low goes, where again, that whole kind of compounding. I mean, it can't compound to the sky forever. It only goes to, plus 50, 60, 80%. But I don't know what comes along and kind of, puts a cap on it and turns the tide where things, kind of narrow out a little bit. And a lot of it's just based on trust. I mean, it doesn't need to be a bad thing. I think if everyone contracted on a longer term basis, like a 3-year basis, and everyone trusted each other on both sides of that contract to do what they said they're going to do, you wouldn't see these wild swings. But the challenge is the cycle runs on 3 years and most bids run on 1 year. And nobody wants to be first to trust the other guy that they're not going to take the best market opportunity when it's presented, because we think it's, we think we'll get rewarded for that, when the market swings the other way. Yeah, and it goes both ways.
That's why you're seeing the emergence of something like Leaf Logistics, right? Doing futures market in trucking, and it'll be interesting to see and track. I know I'm close with those guys. I'm tracking what they're doing and excited to see that as like a part of people's portfolio contract spot, something like futures. Noam is a lifelong technologist and operator, maybe not lifelong, but certainly career long. I don't know what it was like before American Backhaulers. You're much older than I am. So what do you think? How do you kind of take this? How do you think this will impact the RFP process, kind of these wilder swings?
Well, I think that question is interesting because while, as Pickett is showing us, a lot of the industry is staying the same, the RFP process really needs to change, because I think the industry as a whole has a commitment problem, right? It's who's going to abandon their commitment first. Contracts are pretty meaningless, particularly in the truckload industry. And shippers are now taking their bids out, and more frequently when the market is soft, and carriers are abandoning their commitment when the market is hard. So I think the RFP process is going to be under strain unless, as Pickett said, these commitments are really honored and for a longer period of time to smooth that out. And that I don't think is going to happen right now. So I think that crisis of commitment is something has to resolve itself against a market that is extremely dynamic in the short term and the long term. And I think part of the problem is shippers' expectations may be unreasonable. How does an asset carrier make a commitment on uncertain shipment dates and frequencies, right? If you have a shipment every day and it's every day, that's one thing. And certainly price is a factor, but some of the expectations of shippers are unrealistic, and carriers are continuously forced to make themselves more productive and more efficient, which means they've got to tighten their networks and make them more efficient, which really the only way they can do that is by reducing the lanes that they accept to create some consistency there. So I think there's a lot of dynamics that have to change. Technology-wise may therefore have to come in to address this by allowing the shift between contract and spot to become much more fluid, to create dynamic routing guides that you can transition based on real-time behavior rather than have to make these boardroom decisions about whether you're going to abandon carrier X or carrier Y. Because the reality is the response is too dynamic and too many factors come into play. And that comes from both unexpected, production gets delayed, a warehouse closes, a forklift breaks, all these things affect things so fast that we need to be able to respond. But I think the RFP cycle, we have to figure out a different way of defining what that commitment is and how we're going to honor it.
This has been great so far. I think this is a pretty natural transition into kind of the next phase of this conversation in terms of how can companies kind of prepare for these market shifts in the future. I'll start with kind of this question of Glotz. You talked a bit about, containerization containers, and the imbalance, whether it's like east to west or west to east, and that affecting the markets. I've been curious from talking to some of the international folks that I work with, how they see shift in globalization changing with, COVID, right? And supply chains sort of diffusing from Southeast Asia. Will that impact the domestic market? How do you see folks being able to first of all, just from a starting point, get smart on preparing for the kind of the shifts that are coming, Glotz?
Well, I think first of all, you have to have a procurement strategy. I know folks touched on it earlier, right? When we were talking about what's broken, I do think the RFP process is broken. Contracts are predicated on some degree of failure, right? So I think we have to get better there at defining a contract. We have to understand and get.
Can you define a procurement process? Like, what does that mean in your mind?
For me, it's having a strategy, looking back, taking all the data I can get, looking outside of my four walls. How do I compare myself to the broader market? Looking where I've had success, understanding where I've had failures. I mean, if you look at the truckload industry in particular, I mean, 55% moves on private assets, 35% for hire, and then roughly 10 or 11% is going on brokerage of the 800, 900 billion, whatever it was this last year industry. I don't think that changes, but I think the way that people procure, to Noam's point earlier, is going to shift to more of a dynamic capability for that, 3PL or long tail of capacity. And so I do see that transition happening. I think you got to get into the details. You got to understand where there's opportunities. You got to prioritize and share all this data across your suppliers and your stakeholders. You got to build contingency plans, and you got to look for optimization opportunities upstream to your suppliers, downstream to your customers. Then you have to instrument as well. Once you go through the process, you have to instrument and be able to react very quickly. And then last but not least, you need some sort of technology stack that's going to empower all these decisions to be made. So I think it starts there. There's a lot of gaming, I can tell you, that takes place. So segmenting, maybe your 3PLs from your asset-based providers to prevent a lot of the gaming that takes place in these RFPs, looking for tail spend kind of management programs that I think is helpful. And then how do you react with this dynamic data? How do you understand the market and how it's performing? I mean, awarding a carrier 10 loads a day and giving them 20 one day is just as bad as giving them 2. So making sure that you're staying and honoring those commitments and understanding where there's opportunities in the market to maybe supplement some of that capacity needs.
And I think it's important, if this commitment issue is going to change and procurement's going to change, I think it's got to start on the shipper side, that the shippers got to give the carriers the opportunity to fail, but then have technology that allows to them to respond to that failure instantaneously. Once shippers start abandoning and rebidding it early before a carrier's done anything wrong, that really sours the relationship. So when we talk about, Glotz earlier talked about technology really needs to, it's still a relationship business. Technology makes our people and our relationships more productive and be able to work better together. It also needs to allow us to honor our commitments better by allowing us to respond to failure faster. Yeah, and that's where Freight Friends really placed our bet, is on this dynamic routing guide that can incorporate the level of commitment that you want to honor and adjust it based on client need. I'm sorry, Glotz.
Well, I was going to say, if you think about failures too, part of the process is the shipper has pushed all the work to the carrier in 3PL, right? So I can get a shipment today. It's great for me. I want to accept it. Then I go out to procure the appointment, and I have an 8 a.m. pickup and a 4 a.m. delivery on a 50-mile run, and that obviously isn't going to work, right? So, and you can run algorithms to kind of handle those exceptions, let everything flow through, reduce friction if all the appointments were preset, as an example. And
well, and to your example from before, Glotz, right? I mean, they're putting all the work on the transportation providers, even through the RFP process, to know the right information to quote. Right. Yeah. I mean, in terms of freight flows, how predictable it might be, you typically get, you'll get maybe an origin zip, a destination zip if you're lucky, and an aggregate volume for the period of the bid. And it's left to transportation providers to sort of parcel out, is this going to a CNS where I'm going to be, I might have to worry about pricing in 6.5 hours of detention? Is this going to be appointment load unload? Am I going to have floor loads? What am I dealing with here? But Pickett, I'm going to come to you for a second here. I mean, certainly we can look to transportation providers. We can look to shippers and say, hey, shippers are going to have to, we need shippers to do this. We need shippers to do that. It's really, really easy to look outside and say, I need somebody else to do something different to make my business better. But what are are there opportunities, or what are the opportunities for providers to look inside their four walls and say, hey, here's how I can prepare better for the future?
Yeah, I think it's developing their own understanding of the market cycles. to the point where you've got enough conviction where you can actually make a decision. You know what I mean? So I mean, you got to, it's tough. Even understanding, and then based on past history, just the waves that are coming is still very difficult, even within Coyote, right, to get past the noise of kind of the here and now and actually make decisions that result in financial outcomes that are completely different than what the current data is showing you. And it takes some conviction and some courage to do that. And you don't get that without having enough of an understanding of your own vision of what's coming, versus just waiting for the next forecast from Pickett Research, for example, although that will help, or anyone else. I think you got to understand, you got to believe it. And if you don't, then just hire someone that does and make sure they've got the authority to make decisions.
I have to boot you. We said you couldn't pitch your business, so I would have to boot you. So,
but to a lot of Glotz's points, and Noam as well, you've got to build a capability, right, to understand what's happening to you as you move through the cycle, and the operational controls to actually do something about it. And so, at the very least, you get a sense of, okay, are we heading into a net inflationary or deflationary market, and what does that do to my truckload volume base? Right. So it's almost you take what that green line was doing in the last slide and kind of what the blue line is doing, and what's your contract position relative to your spot decision, and how did your contract shippers behave the last time we had similar market conditions, and start to kind of align your technology resources, your human beings, right, your people, your relationships, in a way you're almost anticipating right where that puck is headed, and so that when you get there, you're already set up, right, to be able to operate in that kind of environment. And it's not such an abrupt change as to what you thought was coming when you started the year.
We've talked.
There's no secret sauce to say. Get a formula for predicting the future. Make sure you've got the operational, organizational agility to move pieces around, certainly from year to year, to anticipate that, and then make sure you've got kind of the communication internally and the organizational relationships to be able to try to nudge the battleship, depending on how big your ship is. Maybe it's not. In one direction or another, as the data starts to come in and kind of that future starts to kind of reveal itself.
I have a follow-up question for Kris, because I know there's a lot of brokers on here and people are, there's a lot of new entrants and people are wanting to know, how do I get into these RFPs? What can I do to really impress somebody as a new provider and demonstrate my capabilities? I'm curious, Kris, if you have anything for the audience that you would share as what should they be using to kind of jump in and really tell the story and set themselves apart from others?
I mean, ideally, it's not price as the only thing, right? That's going to lead to some negative outcomes. Hopefully, you've got something to talk about besides just price. I mean, again, if you can educate, right, the shippers you're trying to engage with, and can you tell them something they didn't know in terms of kind of what's happening behind the scenes? What is the state of technology? What are some unique capabilities that you can provide as a broker, if that's what we're talking about? Right, that can help them weather kind of what's coming up. And the market cycle is always a good entry rate to that conversation, right? Because ultimately you're telling the shipper something they didn't know, and you might want to be thinking about this, and here are things that we can do to help you prepare, and therefore it might make sense to make a spot for us at the table. Doesn't need to be a big spot. I think you also want to kind of guide the positions you're gunning for relative to what you see coming. And in an environment where, if the spot line does indeed crash below contract by the end of the year, which I'm forecasting, then what it's going to feel like, right, by kind of Q1 is it's not going to be any spot left, right? Because all those enterprise shippers, whoever's contractable freight, will see 100+ primary tender acceptance, right? Rates, loads won't get past first or second on the routing guide, right? Because let's say you've got a primary asset in place at number one, right? That asset will take as much freight as you can tender them, right? Because those rates were negotiated in Q4 of 2020. And there aren't more attractive opportunities out in the spot market. Therefore, whatever I can't feed my fleet with, I can kick over to my brokerage, and they can find capacity to move this at an attractive margin position, right? So if you're coming into 2021 fundamentally spot biased, right, that strategy worked out great, last year. But if that's what's driving your volume growth, right, you want to think about how to potentially diversify a little bit. Again, easier said than done. But if you're not thinking about that now, by the time we get into market deflation, it's too late. You can't necessarily go back to the same shippers and say, hey, I want to go back and kind of lower all these contract rates I bid to try to move up in the routing guide. There's certainly shippers out there that will entertain that conversation. But most of them, again, if they're honoring the relationship with those contract awards, you won't, right? So a lot of us anticipating that, spot versus contract volume environment and figure out, what's the best way to position, because I love positioning, right? The organization in terms of your carrier relationships, the shippers that you choose to work with, your pricing strategy for the bid, your operation strategy, and that's going to change whether it's a contract heavy versus spot heavy shipper, right? Because the labor content for a spot load is dramatically different from a contract load that comes over with a rate. It's pre-pointed, the facility, and you can automate a lot of that. If it's a spot shipment, you're going to have to spot that. It's probably from a new facility, and that takes time. And so kind of the labor suck for those loads are just different. And to the extent that you can kind of maneuver your organization such that you've got more of the right people in the right places in anticipation of that, you can find yourself in some pretty competitive positions.
So if I'm a shipper or a broker, what do you guys on the panel know? I'd love to get your input too on this, but what do you feel like is the best index? If we're going to peg something to an index to kind of predict those ebbs and flows during the course of the year, I'm sure, Chris, you would love everybody to use your index, but
Pickett's conflicted out in answering this question. So I'll answer it for him. Pickett Research.
But is there an index out there that you like, that you think, and where you've seen success, I guess, tying and correlating these rates to the ups and downs, so there's equal exposure on both sides of that relationship?
I want to elaborate on that question. This tender rejection concept is a new index that's been created in the industry, obviously by FreightWaves, and to some degree, marketing power can drive the relevancy of any index, but is it an accurate index is an interesting question. So I'd love to feed that question back to you guys. How relevant is that to predetermining shifts in the cycle?
I do have an answer for that. It has nothing to do with Pickett Research, but the whole idea of, is there an index out there you can create, more balanced longer term truckload rate agreement? That's what started the whole line of research and resulted into the whole curve itself. Is we were trying to solve exactly that problem. Is if you want to put in place a 2 to 3 year truckload rate contract, what could you put in there for year 2 and year 3 to allow rates to adjust in a way that was deemed fair and equitable and in line with the market, didn't require either the broker in that case or the shipper to take on more risk than they should. And we sponsored, MIT research. We sponsored an MIT thesis on this, I don't know, 10 years ago. And there's a whole, survey of here's all the stuff that's out there, whether it's CAS, whether it's, DAT, whether they're macro indicators, is it a basket of industrial production and inventory or GDP or consumption or whatever it is. And the result was there's not a great index out there. And I think we looked at the orange line, and that's all a cute, kind of tidy, right, nice cycle, and that's all interesting, but that's a national level index. We know that there are certain nuances, whether it's regional or certain equipment classes or particular commodities, that don't necessarily move in line with the rest of the market. And the challenge is the deeper you go into an index, where you start to get to the lane level, the less confident you are about the results of that index.
That's what I think is so difficult about the tech companies that are trying to predict price, because there's so much that goes into price. And you hit it right there, Chris. I mean, it's time of day, lead time, it's commodities and industries and all those things, which makes it so difficult to expose a price, right? And be able to execute against it with all those variables in there, the value of the goods, all the nuances there, the delays in demurrage at facilities and how that plays in to that price. It makes it so hard just to take that kind of blanket approach.
Yeah, and it's interesting, those companies that are making committed automated pricing, the only ones that can are the ones that are funded well enough to take heavy losses when they're wrong. And how long can they continue to do that, and how long will they honor that? And it's private equity that's driving some of these changes, just funds to be lost rather than real technology advances. We're very wary of this technology-based pricing being able to respond truly. And at some point, the industry's got to start to the whole industry, shippers, brokers, carriers need to start to think about, the relevance of freight costs versus total productivity and service on the market, that the pain the volatility is causing to try to save yourself 10 cents by not honoring your commitments.
I'm going to jump in. That touches on a question here from the audience. John Oates asked the question kind of about some indexes and tools. So John, I think if that didn't answer your question, feel free to submit another one. But data is something that's come up a number of times. Chris Torrance of Optical Dynamics, who Glotz mentioned earlier, submitted this question about data, and data access and accuracy remains a major obstacle in the space, as we highlighted a few times, specifics of where that's a problem. As an industry, you guys have thoughts on how we can improve kind of this ongoing data plumbing infrastructure issue? And does anybody actually envision sort of an industry-wide data standardization and governance? Pickett, I know how you feel about it, so I'm not gonna go to you first. Noam, let's go to you first. What do you think we can do to kind of touch some of these things, and do you ever see that being an
Give me a little more, elaborate for me on the data plumbing that you're talking about.
Well, I didn't write the question, so I'm going to assume that Torrance means, our ability to share, more information in an automated fashion, right? I mean, Project 44 is data plumbing, but our ability to, not rely on EDI. All right, Glotz, go ahead. I think you know what he means.
I think he's talking about.
We're going to go to you first, then.
I think he's talking about data governance, and also about the archaic nature on how our data moves today, which is wildly EDI, disparate systems, trying to aggregate that and create that data normalization layer. And how do you get that cleaned up? It's, the biggest problem is all this data lives in all these disparate systems. It's very siloed. It's hard to get access to, and there's not a lot of standards between systems to systems. You think about an enterprise shipper that's made, 5 or 6 acquisitions, has 10 business units. They're operating off 10 different tech stacks. The first thing you have to do is kind of pull that data together and create that data normalization layer and create the governance around it. And I don't think that has evolved where it should. I think EDI as well, none of this is real time. It's all batch data. So moving from the EDI to an API standard, I think everybody in the industry is really cheering for to happen. But why don't you ask the data guy here, Chris? I think he might have.
All right, yeah, I'll go to Pickett then. Go ahead, Pickett.
I don't know. I think it comes down to incentives, and again, I forget who said it. You've got all this data that's locked into these different silos. If you're talking about potentially competitive businesses, right, sharing data, you have to think at the point where the value that's created by sharing the data overrides the risk that you perceive by sharing that data, right, whatever it is. I think certainly, EDI to API is a trend that's going to continue, and it should. I think it becomes easier to kind of share data in real-time ways going forward. It should become cheaper to store data in different places and interrogate that data, in different ways, through things like web services and cheaper, faster, algorithms and more, data scientists, right, that are out there. But I think it ultimately will come down to competitive risk and the rewards and the benefits of, collaboration. And I think, to Glotz's point, you see even within the same enterprise, why does dwell time continue to be such a huge issue? Ultimately because transportation pays for it, but warehousing is driving the issue that's resulting in the dwell time is often the case. And so, you get transportation involved, and it becomes a whole, across the aisle, summit thing with their, colleagues on the distribution and warehousing side that don't really care, right? Because they're not bonused on dwell time. They're boosted on inventory levels and, in turns and fill rates, right? So I think it's a bigger issue certainly than just transportation, but I think it's optimistic. You start to see the underlying technologies that could support this starting to reach a level of maturity where they are actually creating value. Now it becomes a question of incentives and what's the reward of sharing your data, what do you get out of it, and does it override any perceived risk you've got to get over from actually being a little more open with your data.
If I can re-engage after my initial pass, I think the ELD mandate.
Nope, that was your chance.
I think the ELD mandate had the opportunity to create a tremendous proliferation of important data that could be shared. But U.S. privacy laws and it really, the ELD data belongs to the carrier who signs up for it. So a lot of these visibility platforms have come into that space because the potential of shared visibility and what that data could do to make our whole industry more efficient, it seems excellent. European laws are very different than US laws. So I do think some legal changes need to be made that will allow the industry to become more efficient. And that data is a treasure trove once we figure out how to share it in a way that can really benefit all. And certainly in shipment, it's the equivalent of that on the shipper data as well. But that's an interesting where that's going to go legally in the future. I think is a really interesting question.
And it depends on what kind of data. If the data's got a dollar sign in front of it, right, it might be a little harder to get over from a perceived risk standpoint than long and timestamp. Like a location tracking data.
Right.
If everyone sees that, can you derive better transit time estimates or dwell estimates across the entire industry? Would that be a good thing for everybody? Probably, but you get everyone to share all their pricing data. Maybe not, right? So I think it depends on also kind of what data we're talking about and who gets the most benefit.
Yeah, I think that's a great point. Glotz, I'll jump in really quickly if you don't mind. I think that's a great point because, I want to drill in on it because I don't want it to get lost. You're talking about not all data is created equal. And observation, and something that we spend a lot of time at Carrier Direct working with our clients on, is understanding that not all data is created equal. And one of the problems we have as an industry is treating all data as like the most valuable, most important data. And some of it is much more valuable when it's aggregated with someone else's data, and other data, to your point, like pricing data, is something that might need to stay behind a curtain. So Glotz, I'll go ahead and go to you. How have you historically kind of thought about looking at different pieces of data differently and assigning those values and what you're willing to share and not share?
Well, I was just going to say that, one of the problems, one of my favorite problems to understand is what defines density or liquidity in a given lane, and what is the impact of dwell time have. If you have so much scale, if you're a large retail shipper and you have so much scale and your dwell time's poor, how is there a point or an inflection point where I have so much density it doesn't matter? And what does that look like from a rate perspective, right? Versus if I'm a 5-star facility doing everything well and I have limited scale, can I still get that preferred rate because I'm easy to deal with? So looking at density from a data perspective, what do I like to share? I think we're not going to get ahead of these problems until we share as much as possible. I do agree that maybe pricing is not going to be shared, but to a point where we can help drive efficiency, because we're all trying to solve this utilization and doing more with less. As much data as possible around that. I think visibility data is absolutely paramount to understand your business. I think facility insights, understanding hours of service at these facilities, all that comes into play. And I assume we're talking about price here. How do I derive it at price, and how do I think about that? But those are the insights that I really want to get my hands on as a data person, and the data person is always going to tell you as much data as possible, and I'll clean it up and figure it out. But I think the first step is just looking at yourself outside of your own four walls, and I don't think people do that often enough.
But you got to share the benefits. It's got to go both ways. Think about just the evolution of how important all of a sudden real-time tracking is, right? So all of a sudden everyone needs a truck location every 15 seconds. You can make different decisions based on that. Maybe not, right? So the whole push was, hey, brokers, hey, carriers, whether it's your ELD data or phone signal, not as much anymore, we need real-time tracking. And okay, what do we get out of that as a broker or as a carrier? Well, you get my relationship and you get my freight. But if you actually got shorter dwell times and faster turns and less detention, we're all for that. So we've been kind of consciously, optimistically waiting for the day that suddenly can look back and say, over the last 4 or 5 years, dwell times have gone down as a result of everyone knows where the trucks are at. But that day certainly hasn't arrived yet. If anything, it's arguably gotten a little worse.
And that's why I think there's this huge push toward some of these applications, a dock 411, a truck map, if you will, to be able to get some of this dock level information, what's available there, what are the appointments like, what's the dwell time like, all of those things to help us make some of these better decisions. With we only have a minute left here. So unfortunately, we didn't get to all the questions. And for anybody who submitted them, Mike Bledsoe, who goes back a ways with Noam and I, and some anonymous attendees, Greg Medina submitted another question. Thanks for your questions. I want to thank the panelists a ton for this conversation. It was really enjoyable for me. I certainly learned a lot. Anything else you guys, I mean, before everybody signs off here, we're at time. Anything you guys want to add that we should take away from this webinar? The answer no is fine. I realized that was an off the wall question.
I just had a wonderful time being with both Chris's and you, Ryan, and I appreciate you joining us, taking your time for this, and I appreciate all the attendees for joining. I think this was a dynamic, fun conversation, and I'm glad to have been part of it. So
awesome. Really quickly, where can anybody learn more information from each one of you? We'll start with Glotz. Glotz.
Christopher Glotzbach at gmail.com or hit me up on LinkedIn.
Noam at freightfriend.com. Please check out our website, freightfriend.com.
Pickett.
Chris at picketresearch.com or www.picketresearch.com.
Awesome. I'm Ryan. You can find me on LinkedIn. I would imagine some of you know that. Twitter is another good place for me at _userprime. I'm not going to give my email address because you'd have to learn how to spell my last name. Thanks everybody for joining. Really appreciate it. It was great to meet y'all, and take care.
Thanks, everybody. Bye.